Most people believe elite trading requires a genetic gift. The assumption is that success on Wall Street depends on a high IQ, perfect timing, and the ability to process wildly complex forecasts. Richard Dennis disagreed. He viewed the markets through a different lens, concluding that trading was a mechanical skill, a rigid set of rules taught to anyone. By 1983, Dennis was known as the Prince of the Pit. He traded with such immense scale that a single handwritten order from him could move entire financial markets. Dennis decided to use his capital to prove his theory. He engineered an experiment designed to dismantle the industry's reliance on the idea of innate talent. The experiment began as a bet with his partner, William Eckhart. While Eckhart argued that traders were born, Dennis claimed he could grow them systematically, like turtles on a farm in Singapore. They placed a recruitment ad in the Wall Street Journal, attracting over 1,000 applicants. From that pool, they selected 23 candidates. These turtles had zero financial experience. The group included an actor, a security guard, a blackjack dealer, and a 19-year-old computer hobbyist. Dennis sequestered these rookies for 14 days. In that time, he taught them every detail of his proprietary multi-million-dollar strategy. The experiment tested whether ordinary people could adhere to a mechanical process when every instinct urged them to rely on their own judgment. The strategy wasn't an encyclopedia of complex algorithms. The rules were simple enough to fit on a single whiteboard. The system's core is the 20-day breakout. Breaking the 20-day high triggers an immediate buy signal, eliminating market prediction. To handle volatility, the average true range formula measured price speed, mechanically dictating trade size. High volatility required smaller positions. Steady markets allowed larger ones. Dennis engineered these rules to strip away the emotional burden of forecasting the future. To manage risk, the turtles were forbidden from risking more than 2% of their capital on any single trade. This cap suppressed the fear of ruin, making it easier to take losses mechanically. They were also required to pyramid into winners. While most people want to secure profits early, the turtles were forced to add to their positions as prices rose, pressing their advantage when they were right. Dennis also enforced absolute silence. He banned financial news and commentary to starve the ego's need for external validation. Price action was the only data that mattered. By following these rules, the novices generated over $100 million in collective profit in less than 5 years. The results proved that the power of the system resided in its rigid architecture of discipline rather than any secret market indicator. But despite being handed a proven system and millions in capital, roughly a third of the turtles washed out. They failed while sitting in the same room and receiving the same instructions as the massive winners. The catalyst was the emotional pain of a sideways market. As seen in this chart, a chopping market forces the system to take consecutive small losses. The participants who failed couldn't endure the drawdown. Their biological drive to avoid short-term pain overrode the mathematical logic of the system. These failing traders fell into the genius complex. They believed they were smarter than the rules and began skipping valid trade setups out of fear. They started tweaking the mechanical rules to try and predict the market. This unforced error was driven by the urge to avoid emotional discomfort. The experiment showed that optimizing a system to avoid pain is exactly what prevents a trader from making money. It led Richard Dennis to make his most famous claim, that he could publish his exact rules in the Wall Street Journal, and no one would have the discipline to follow them. The turtles proved that lasting financial success depends on the mastery of one's own psychology before the mastery of any market.